how much money is needed in super to buy a property. Uh, you can see you can buy a property from, say, you can get properties at around 300,000 as well in regional areas. You can get some slightly lower prices as well, and you can buy up till as much as you can. But what happens in an SMSF is, as we said, the objective should be very clear. First is very, very roughly, and this is what it's when I talk to accountants, they tell us, yeah, unless and until you have less than 130, 140, 150 in your super, you really are not getting a benefit out of the tax of the expenses which are there, because it's an expensive proposition to have an SMSF. So your property, if you're having about 150K, roughly you should be able to buy a property of $450,000, $500,000 in your SMSF, subject to your borrowing capacity. But any lower, you may not really have a benefit in terms of costing. Having said that, if you have lower ones, and if you really find something which is very interesting, which is going to give you a long-term benefit, and you believe in it, and your buyer agent believes in it, and your mortgage broker believes in it, your accountant believes in it, there is no lower amount or a higher amount for doing that. How is your value proposition different from other BAs? Maybe I'll give it to Julius to answer this.
Yeah, so it depends on how other buyers is operating, but in our case, basically we do a full analysis with the multiple sources to understand how market is going to be performed in next 6 to 8 months. Also, particularly when it comes to the SMSF, we just don't go and buy any property which is available in the market. So in SMSF, we have a certain strategies. Similarly, where the population growth is pretty high, and then the areas are poised to go for the growth for the next around 10 to 15 years. Also, the tenant quality is better, and then and in long-term basis, you'll have a good performance of the property. We only select this property. Also, we don't go to the properties which are we don't go to the super regional into the SMSF. We don't go to the properties which are pretty old, 50 years old with the bigger land, because you can't apply the subdivision strategy. You can't put the granny flats in that. So we look for the properties which are decently made, less than 10 years, 10 to 15 years old, where the long-term growth is very good. That's it.
Speaking, where can one buy a property less than $300,000? All right, Julius, can we get one?
That's a tricky question, but at this stage, we don't buy in SMSF anything at 300ish, because few properties available in super regional, but they don't match our strategy and the research. So the absolute answer is no at this stage.
Yeah, so maybe not in an SMSF, but in a normal case, you may find that it suits your circumstances, but that's not what we are talking right now. You can still find properties which are less than 300,000, as Julius says, in super regional areas or in smaller areas, much smaller, but they should really fit with the SMSF strategy. You should be able to convince yourself. You should be able to talk to your accountant. You should be able to talk to your mortgage broker, and you should be convinced that it's going to really get you a benefit. It's just not getting a property in the SMSF, which is important. It has to be fitting into your strategy bit. And that's why it's important that the property, it's not about the value, it's about the value proposition or your objectives and your goals, and it should match with that objectives and goals. And then the prices are there. 300,000, a lot of regional areas where you can get a property, fit super or not, that's a different discussion. How do you do inspections and negotiations and due diligence?
Yeah, so inspections are done, depends on the state. So we have a local BA across Australia. We do a physical inspection of the property. In terms of the negotiation, the amount of transaction we do, we try to find most of the properties through the off-market. 97% of our properties are off-market sourced. According to that, basically, we'll do all the comparables. When the properties are through the distress sale or sometimes deceased estate, someone is divorcing, these properties are much below market price. So every time we try to say around 4 to 5% on the property price, plus the amount of time which you're going to spend in that particular market would be a bonus, because we source the property much before the time you're going to spend. In terms of the due diligence, yes, we check fire zones, flood zones. We check is there an easement on the property, any covenant, any caveats on the property, whether the property is very close to the high tensile wires, whether the property is very close to the train lines, major highways. We do all of this due diligence, and then we put that report in front of the client and let the client decide whether they like the property or not. So in our entire process, we give you the reports which shows why we are buying there, what are the future prospects of that area, what are the comparable values with the neighboring properties, and then how much we are buying for, how much we are saving, how your cash flow will look like. With that, we'll give you the supporting artifact document of the due diligence report, plus the video inspection. So basically, these are the steps which we follow to satisfy every client.
In your super, can I buy properties which I can flip and enjoy the capital gains benefit? Julius? So if you're looking to buy properties to flip, okay, again, it's purely about strategy. So when you're looking properties to flip, you have to understand when you want to flip, you will want to enhance the value of a property. When you're looking to enhance the value of a property, you're going to do some kind of a construction. You're going to do some kind of a thing in it, some kind of an improvement in it. And as we were discussing at the earlier stage, it's not so easy to do construction. It's not so easy to, the rules don't allow you to do that, to do major upgrades and do all that stuff. So you have to be very, very clear about how you're going to get the funds and whether that fits in. And you need to sit with your accountant and try and see whether they are allowable expenses, whether you can really get into that or not. Unless you can do that, it's not, this is not the structure. There may be trust structures which work there, company structures which work there. That's not the topic for today. You can obviously listen to us when we are talking about those sessions. I think we are doing one on this thing in about 2 or 3 weeks, if I'm not wrong, 3 weeks from now, if I'm not wrong. But yeah, if you are interested in doing that, that's the webinar to attend. But SMSF, if you're looking at doing major changes in construction and that kind of a stuff, not the right tool for you to get into. There are much better and much easier structures to work through. But again, that's a discussion for another day, and that's a discussion for another point. 80.
The first question is, do you have a chart data showing appreciation of the properties?
Julius, that is for you.
Yeah, so we do have a lot of data which we can produce to show, okay, how the appreciation of the property looks like. Probably there is a slide at the extreme end.
Okay.
No, not that. Yeah, that's the one. So when the entire Perth was growing at around 26 to 27%, we've delivered around 54.95%. So why we are giving that in the broader perspective is because I'll give an example. When everyone was looking at demand and supply related indicators, during that time, there was a lot of buzz about the Rockingham because on the every data platform, it was showing too good, but we were looking at in a different angle of where the fundamental growth will come. In 2020-ish, the Rockingham was sitting at around 480-ish to 500-ish. And then similarly, at that time, we were investing into the Hawking. So basically, currently, if you see the Rockingham's median prices are around late 600s versus Hawking at mid 800s. So that's the difference. So we do have a lot of the similar examples available with us.
What percentage of clients have seen this kind of appreciation in properties? So, yeah, you can take it.
There is enough number of clients who have seen this type of appreciation. It depends on the client strategy. So basically, when we look at the detailed portfolio structure from last 3 years, the markets were bullish, and then every pockets you invest in Australia, whether it will be Perth, Adelaide, when you go towards the Brisbane, if you go towards the regional Queensland, now the regional NSW is coming into the growth cycle. So there was enough growth which we have achieved for most of the clients. But moreover, fundamentally, what we have achieved is the suburb which we have selected outperform than the normal national average. So around all of our clients, those who are invested with us, have seen the growth.
There's somebody who's saying that I want to rent west, but I'm not sure about buying a house and land package or buying a property, a house somewhere like established house that you're talking about.
Yeah, so for the investing, the first stage will start from the strategy, right? Because when you are investing, that means you would have a goal in your mind. Either in next 10 years, probably you would like to buy a property in Sydney. So that's why you're building a portfolio where you'll have a great equity, or you wanted to build your passive income, or so on. So basically, when you look at the home and land packages, I'm not saying that every home and land package is bad, but home and land packages are always coming into the areas where there is a lot of supply. So if there is a lot of supply and higher demand, so there is a lot of supply and lower demand in that area, in short-term basis, you will not get the equity. When you buy the property in the areas where the supply is lower and demand is higher, you can achieve the short-term growth, which will allow you to withdraw the equity and then buy the next property. Because in the next 10 years, every property will become double. But when you get the short-term growth, so it will allow you to withdraw that equity, so you can jump onto the next property, buy the deposit, and you can enjoy that compound growth. So that's why our preference will be, we'll go towards the only established property in higher demand areas.
Okay. Yeah, that's good. How long ago was your PropWealth Next strategy of coming up with the scores was implemented?
So PropWealth Next was in beta phase around 1.5 years ago. Our system, and so our team and the research team is using it since last 1 year. We've got enough details, and then we improved in multiple segments. At this stage, it's due to release to the market for free of cost. Also, we are planning to introduce the AI related functions and the bot function within the PropWealth Next. So yes, it's more than an year system which is already been into the production, and then we are using it nicely. But before that, it took around it's around 2 years to build the entire system.
Okay. Is PropWealth Next available currently? Is it free, or is there a fee for this?
Okay, so PropWealth Next is currently available only for our research team, but we are planning to release a subset of the PropWealth Next to market in next 2 months. It will be integrated with a new website which we are launching, where it will be part of the research hub. You can have a full access to the maps, as well as you'll have a full access to the trends of the particular council and the suburb. Also, in future, we would add another few filtration criteria, which will allow you to understand which kind of metrics to use, and then how we select the particular council. So it's a long due process, but yes, it will be available for free in next few months.
Okay, cool. My budget is 700K currently. I know that I'll be getting more money later. So what strategy would you advise for me? Should I buy a house to live in or buy an investment property? Okay. I'll take this, Julius. Yeah. So if you have budget is 700K right now, and living in, this is Sydney. Okay. If you're talking about a 700K budget, and if you're living in Sydney, yes, let's look at both the scenarios. If you buy a property to live in Sydney in 700K, you can possibly buy a unit. House is going to be very difficult, a fully detached house, because generally the prices have gone up, and a house will cost anywhere upwards of $1.2, $1.3 million and above, even if you're talking about going a bit far off suburbs. So if in that budget, you can get a unit. Yes, the first strategy, if you buy a unit, yes, you can buy it. And then if you're expecting funds to come later, more funds to come later, like you said, you can use that money to buy investment property later. The only thing is, generally, historically, if you see about units in Sydney, most of the units have not kind of grown much in value the way houses have grown. So if you're buying a unit to live in today, few years down, 5 years down, 7 years down, you may not see much growth in the value of that unit. At that point of time, you will either choose to sell it off, make it investment when you're buying your house to live in, moving to a bigger house, upgrading the house. Either you will put it as an investment property, or you will probably sell off, right? So that's one strategy. The only thing there is that, yes, if you wear the investor hat, then you see that, is it a good investment? Of course, you will be able to buy it in a certain location. Alternate strategy is, if you don't buy a unit to live in, the other option is, like you said, that you continue on rent, invest somewhere in property. If you are able to do a good research around where to buy, what kind of property to buy, chances of capital growth can be much higher. in 5 years itself, if the property grows by 10% in a 700K budget, you're talking about good maybe 200, 300, 400K. Even if we be conservative, let's say, even if not 10%, even if it is 5%, 7% capital growth, still you're talking about a few 100K kind of capital growth. So that is the trade-off. So, but yes, of course, you'll have to continue living on rent for some more time, right? So if that's okay from, like we discussed about social, emotional factors. So if that's okay, then that's something that you have to weigh off. But like I said, it will be better if we discuss this one-on-one. This is still a bit generic. We need to understand a bit more about your financials and circumstances.